everyone, it's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined today with our co-host, Nicholas Ward. Nick, great to see you today.
Yeah, thanks, Brad. Good to be here. And, we definitely want to give our well wishes to everybody. There's a lot of conflict in the world this weekend. We record these on Monday. The market's up today, kind of surprisingly. Happy to see that. But, thoughts and prayers to everybody in the Middle East, dealing with this conflict right now.
For sure. And, of course, today we're going to be bringing a little stability at least to the investing world. Today, we decided to start focusing a little bit on retirement. All of us have to deal with retirement. Mine's coming sooner than you, Nick, but, we got to be thinking about it. My mother's retired now. A lot of my friends are retired. So a lot of people have asked us about retirement stocks and which are the best stocks to own in retirement.
Yeah. And honest, with any luck, mine comes about the same times as yours, right? I think everybody wants to retire early. I started reading a lot on Charlie Munger recently. I think I mentioned that. And then that led me to some Benjamin Franklin autobiographies because Franklin was a huge Munger influence. And I think Benjamin Franklin may have been the first person to retire early in America. Back then, people didn't do it. You basically just worked until you couldn't. He did, however, and so that's really big inspiration to me. I've kind of looked into this FIRE movement, FIRE, financial independence, retire early. So retirement doesn't have to just to be, for, 67 plus or whatever. I think we all want to kind of buy back our time. And that's what this video is about, trying to find the assets that would allow you to sit back, relax, and pursue your passions while other people pay you that passive income.
Well, Nick, it was when I was a lot younger, probably closer to your age, even younger than you. I mean, I was looking to build my retirement portfolio with real estate because that's what I know best. And that was my circle of confidence, still is. And so I started to accumulate, portfolio of real estate, recognizing that could really be good for my retirement. Of course, that all came to a crashing halt due to a bad business partnership as well as the Great Recession. But I still believe real estate is an important asset class for retirees. And I'm going to be talking about specifically some real estate investment trusts. But first, we want to provide more of a diversified recommendation list for you. So Nick, I know you've got some really interesting picks today in the food and beverage space, the alcohol space, spices, railroad, and healthcare. So once you go through that list, I'll be providing a couple of REITs that we feel like are really safe for retirees.
Yeah, and it's Franklin owned income properties in Philadelphia and throughout the coastal New England. So you're right on the founding fathers' route to retirement. I think that's good. Yeah, I knew Brad was going to talk about REITs when we started to plan this out. Obviously, that's his wheelhouse. I knew those REITs would likely have higher yields, 4, 5, 6, 7%, et cetera. Everybody's yield that they're going to chase in retirement is going to be different. It's going to depend on, one, the size of your nest egg, and then two, your expected expenses, lifestyle expenses in retirement. Some people can live on $50,000 a year. Some people need $250,000 a year or more. So I wanted to provide a kind of a diversified yield kind of across the board here. So I didn't do anything less than 2%. I assume, you need $10 million or something to retire on a yield that low. But I assume that these yields, 2 to 4%, can combine with Brad's yields and create a pretty well diversified portfolio. So the first stock I'm going to mention is one I've mentioned several times on this channel over the last several months. It's a beaten down dividend aristocrat. I think it's too cheap. I know why it's cheap. It makes sense, but I'm talking about PepsiCo. This is a company. They own, soft beverages, sodas, Gatorade, etc. They also do a lot of snacks like chips, pretzels, kind of all the things in the unhealthy aisles of the grocery store. And that's why the stock's suffering. There's Trump got elected with the MAGA movement, Make America Great Again. And then Robert Kennedy Jr. is doing the MAHA movement, Make America Healthy Again. And that is hurting a lot of stocks that obviously don't fall into that healthy foods category, Pepsi included. However, I don't think Americans or just people across the globe, this is an international company, are going to stop snacking on salty snacks, are going to stop drinking sugary beverages. They probably should. All the science points towards those things being very unhealthy for you. However, humans love their vices. So I'll throw up a chart here. Here's a fast graph. As you can see, the stock's trading at its lowest price in more than 10 years. You have to go back to looks like 2012 to see this stock trading with like a 16 times multiple. It is expected to do negative growth this year due to tariffs and kind of consumer trends changing. However, the analysts that cover this, and there's quite a few analysts that cover this company, are expecting to see a bounce back, 6% growth in 2026, 9% growth in 2027. Remember, PepsiCo has plenty of money. They can change their portfolio as consumers change. We just saw them buy the Poppy, the probiotic soda brand, for a couple $2 billion. They can make moves like that, whereas a lot of their competitors can't. They don't have the cash flow or the balance sheets to do so. So I think Pepsi can kind of navigate these waters, change with the times. It's yielding 4.3%, cheapest valuation in more than a decade. I looked it up really quickly. Pepsi has been, paying a dividend for 53 consecutive years, dividend growth. So not just paying the dividend, they've been growing the dividend every year for more than 50 years. That's a sleep well at night stock if I can ever see one. And I think the valuation looks pretty attractive right here.
Good pick. What you got in the alcohol space?
Yeah, the alcohol, this one's tougher because Brown-Forman they have had an absolutely terrible 2 years. And I'm including them with Pepsi. The sort of the Maha movement is hurting Brown-Forman as well. America, and this is primarily a North American sales company. They own a lot of liquor. I looked it up. Here's they own Jack Daniels, Woodford Reserve, Old Forester, a lot of just the famous American bourbon brands this company owns and sells. And for years and years and years, that was great. We were drinking more bourbon. They did the premiumization concept, which means they kind of take, they're selling their bourbon for more and more and more. They kind of justify it. Hey, it's got to sit in the barrel for 15 years. So we can get a lot of money for it. It makes sense. There's a limited supply of 15-year-old bourbon. And if people want it, they'll pay for it. That happened for a long time, but things are changing now. And it's the rise of cannabis in America, the Maha movement. People are realizing that alcohol is not very good for you. It's not being demonized like tobacco is, but it's not far off. And that's caused pretty poor growth in the last couple of years. Also, the Trump's trade war is certainly not helping this company. There are Canadian, grocery stores famously just throwing all of their Kentucky bourbon out onto the street. People are boycotting. When you think of America, you think of bourbon. Some people do. So any boycotts to America, this company suffers. But the valuation has gotten incredibly cheap. Here's the fast graph. As you can see, we're at less than 15 times earnings now. Over the last 20 years, the average PDE ratio here is basically 27 times. So we're the margin of safety, we're talking 50%. It's been cut in half. You don't see a sell-off. The last time the shares were this cheap was during the Great Recession in 2009. That was a generational, once-in-a-lifetime buying opportunity, or we thought. Well, here we are again, right? The stock went from $12 a share up to $81 a share prior to the sell-off. So you can make massive gains with a boring, bourbon company like this if you buy low. And I think that's what the opportunity to do here after this huge sell-off. If you think America is going to be a sober country over the next 20, 30 years, don't buy the stock, right? But if you think people are going to continue to drink liquor, bourbon, wine, everything, I think, but beer, this company has all the spirits in their portfolio. Now's a pretty good, and historically good time to buy this stock, looking at the fundamentals. Shares yield 3.4% right now. So not as good as Pepsi, but still well above the S&P 500's yield. And, I think you get a best-in-class brand of bourbon here for, a bargain barrel price, which I like.
Great. Well, let's move over to spices, kind of move away from the sin stock there, alcohol, and over to some spices.
Yeah, and this doesn't go against the Maha thing, right? I mean, we want to eat healthy food. And how do you make, chicken or all these kind of bland foods taste better? You spice them up. McCormick, everybody knows this brand. The red bottles, you go to the spice aisle, they probably dominate it. There is some sort of store brand, some generic competition coming in at lower prices, but people have been trusting this company for 100 years, and I think that's not going to stop anytime soon. Their stock's well off the highs. In 2022, this is a $100 stock, and today it's at $74. It's trading for 25 times earnings, which is it's hefty. But if you look at the fast graph here, in the last 20 years, they've only posted negative EPS growth one time. So 19 out of 20, really good streak. They're expected to grow this year 3%, next year 9%, the year after that 7%. Historically, you can kind of expect this company to average out at a kind of high single-digit EPS growth rate. Shares yield 2.4% right now. So you combine that with the EPS growth rate, you're right around a 10% annualized return. And then any multiple expansion from here, there's massive upside. I said the long-term average here is 23 and a half times. So we're kind of right in that area on a forward basis. But more recently, on a 10-year average, McCormick's average PDE ratio is 27 times. So we're undervalued. During the last 5 years, it's 30 times. So I don't think this stock deserves to trade at 30 times earnings. I love predictable earnings, predictable cash flows, a reliably growing dividend. McCormick provides all the three of those things, but I don't want to pay 30 times for 9 times growth. So I'm not for 9% growth. I'm not saying we're getting back to 30 anytime soon, but if we do, and there is a precedent for it, you're looking at, 25, 30% annual CAGRs moving forward with a relatively boring stock that sells, plastic jugs of ground up plants. So we love it. These are the types of things that we love. They have wide moats, great brand recognition, and the great dividend streak. I looked it up. McCormick has grown its dividend for 38 consecutive years.
Great, Nick. That's a great pick as well. And before we get to the next pick, which is really exciting on railroads, I want to remind everybody, drop us a comment below, drop us a like. We'd love to get your comments because those comments allow us to provide more content. So any tickers you've got, any companies you want us to follow, drop some comments below. Any questions? Thank you. Now, Nick, let's move over to the next one, railroads. And I'll say I've been doing a lot of research on Bill Ackman recently. Of course, I interviewed him about a week ago, and he got involved in the railroad business. So I'm really anxious, and so of course so did Warren Buffett. So I'm really anxious for you to talk about your railroad pick.
Yeah, if Ackman's trying to, turn Howard Hughes into the next Berkshire, he's going to have to make a big splash in the railroad business. Berkshire owns Burlington Northern Santa Fe, excuse me. So we'll see what if Ackman takes a huge stake in one of these companies. Maybe it'll be this one, and I'm talking about Canadian National Railway. All the railroads I like a lot. If you look at their fundamentals over the long term, they're up and to the right. As far as competitive moats go, I'm not sure that any companies have wider moats than these companies, mainly because you just can't build railroads anymore. There's eminent domain issues. There are environmental issues. There's so much regulatory red tape to build a nationwide railroad. It just simply can't happen. This industry has been consolidating for 100 years. There used to be, 200 railroad plays. Now there's only about 6 that matter, and this is one of them. Canadian National is interesting because it's one of the few that connects in the entire North American continent. Basically, you have Central American and Mexican track, obviously a bunch of American track, and then Canadian track due to its namesake. It is a Canadian company. I think that's partially why the shares are cheap. There's, the trade war has brought a lot of uncertainty with U.S. and Canadian trade, and how's that going to work with cross-border tracks and et cetera, et cetera, et cetera. But long term, I don't think railroads are going to change. They're still the most efficient way to transport massive amounts of goods over land. So, maybe we get electric driverless trucks. Maybe we get, I don't know, air barges or something, some futuristic, some spaceships. Well, I don't think 200 years from now, we're still going to be using railroads. This company yields 2.5% right now. That's well above its historical average. As you can see on the screen, we are down below 20 times earnings at the moment. And that's pretty good for a company expected to grow at 16% this year. It's almost a 1 times peg. That's the cheapest peg ratio of any of the stocks that I've discussed thus far. 11% growth expected next year, 10% the year after that. This is a company that is capable of compounding at that double-digit rate. And as you can see in the past, it is somewhat lumpy. It's a cyclical company. When economies boom, railroads do well. When they shrink during recessions, railroads suffer. This is something you have to own throughout the entire economic cycles. It's not something I would try to time. And thankfully, owning it's fine because it's been growing its dividend for 30 consecutive years. So you can kind of sit back, collect the yield, watch it compound, and just know that you have one of the most diversified railroad companies in the industry. And I think probably the one with the best growth prospects this year. Union Pacific is another one of our favorites, but it's only expected to grow, I think, 8% this year. CNI is doubling that. So that was why CNI was the pick. But honestly, I don't think you can go wrong with any of the railroads if you want exposure to that industry long term.
Nick, is the ticker Canadian Pacific? What's that?
Canadian Pacific is CP. That's another great company. They also have exposure with Canada, the United States, and Mexico. But I'm talking about Canadian National Railway. So CNI is the ticker.
Yeah, Agman actually owned Canadian Pacific, sold it earlier this year to invest in the Mag 7,
Okay.
interestingly enough. But so he's definitely has owned a fairly large position in railroads in the past, going all the way back to around 2012, actually.
Yeah, I follow a lot of these like super investors. Ackman would be in that group, and a lot of them own railroads, and it's because of those moats, right? It's hard to find a business, even Mag 7 technology. We don't know what Facebook's going to be doing in 10 years. I know exactly what Canadian National is going to be doing in 10 years. And that's why, a lot of very rich people like to own that type of company.
Great. Well, last but not least is the healthcare sector, Nick, and I'm excited to hear about that. I know a lot of the healthcare stocks have been beaten down, so I'm anxious to see what you got here.
Yeah, a lot of uncertainty in this sector due to kind of the politics. What are we doing with vaccines? What are we going to do with healthcare research? We've gutted, a lot of the government side. Is that going to trickle over to the private side or not? A lot of uncertainty. Maybe not any. This stock maybe leads the pack with that. And I'm talking about UnitedHealth. Their CEO was murdered in the streets of New York City. Rest in peace. That was such a tragedy. They've got a lot of legal issues right now. You got the Wall Street Journal. You got a bunch of these publications, coming out with, are they coding wrong? Are they, boosting their profits in a immoral way? The government's looking into them. There's a lot of uncertainty about this company right now. And if you're not comfortable with that, just avoid it. Look, there's a lot of stocks like a McCormick, for instance, where you don't have to deal with that. But on a valuation standpoint, UNH is trading for 12 times earnings right now. Long-term average 18 times, so pretty wide margin of safety. As you can see on the fast graph, once again, you got to go back a decade to see a valuation this low. And yes, they're expected to post a pretty poor earnings result this year, negative 20% ish. But that we're getting right back on track next year if you believe the analyst consensus estimate. 16% expected EPS growth next year and 13% the year after that. The company has shown guidance, and they're calling for strong earnings. I mean, they've changed their CEO. The CEO they brought in the company did great under him. I think it was up 400% or something like that during his tenure. So a lot of talent there. People hate this industry. They hate the healthcare, how much it costs to go to the hospital. You go to the emergency room, you break your arm, you get a bill for $16,000 or something. None of it makes sense. The politicians are trying to change it. I don't think they're going to be able to. Trump tried to change it before. Warren Buffett, Jamie Dimon, and Jeff Bezos got together about 5 years ago, said they're going to change the healthcare industry. Arguably three of the most powerful men in the world. They couldn't figure it out. I think this company is kind of too big to fail at this point. I don't think America is going to a single payer, European, Canadian type of system anytime soon. We love our freedom too much for that. So I think UnitedHealthcare is going to be around for a while. I think this is obviously a tough patch for them, a lot of uncertainty, but in 5-10 years, people might look back at today and say, man, I can't believe I didn't buy this company for 12 times earnings. It's not one I own. It's one I've been thinking about though so hard. I mean, it's just like you see the fast graph, look at that sell-off. It's precipitous. It's bigger than COVID. It's bigger than the Great Recession. This is a massive, massive sell-off we've seen in the last couple of months on this stock. And, when you see blue chips experience, get cut in half like this one did, it's usually an overreaction by the market. So I think a long-term investor, may want to think about UNH here.
Great. Well, Nick, thank you for that pick and also all the others. Really good picks. And of course, now we're going to move over to real estate. The interesting part of every ticker that you discussed, has real estate. I mean, so I really believe the stars have lined up for real estate investment trusts. Real estate is one of the, if not the largest asset class in the world. It's certainly one of the oldest asset classes. When you think about real estate, just real estate broadly, not REITs, but just real estate, that's $228 trillion of real estate valuation across the world. So that makes it one of the largest, asset classes. When you think about it, compare that to banks, which is about 20 trillion, or gold at 10 trillion, or oil at 2 trillion. So there's a lot of real estate. And every one of those picks that you just mentioned, Nick, every one of those companies, Pepsi needs manufacturing, they need warehousing, they need office. The spice company, McCormick and Schmick's, they need manufacturing, they need offices, they need distribution, they need warehousing. Every one of those needs some form of real estate. So real estate is really more, when you invest in real estate or REITs, specifically real estate investment trust, you really are investing in, it's more of a commodity play. These companies, they accommodate shelter and commerce and food production, collaboration, and all this stuff. So there's all different ways you can play it. And today I wanted to really just focus on 2 or 3 different companies that I think are perfectly suited for retirees. In fact, when you think about the retirement market and this really what we call the silver tsunami, and I'm right at the early stage part of this, by the way, and all this demand that's being generated for retirees who need income. And that's what REITs were built for. In 1960, when REITs were formed by law, REITs were formed for individual investors and really as an income alternative to provide income to investors. So with that in mind, the first pick I'm going to go to is based right in the South, and not too close to me, but over in Mississippi. The only publicly traded REIT in Mississippi is called EastGroup, and they operate 63 million square feet of warehouses. Now, these aren't your typical big box, large warehouses. These are smaller warehouse facilities that have multiple tenants. I call this flex space. So these tenants come in generally from 20,000 to 100,000 square feet each, and they have warehouses, they have office, they have manufacturing, all kind of embedded within these multi-tenant facilities. What I really like about this company is the diversification attributes. They have one of the most diversified business models in the REIT space. Only 7.1% of the top 10 customers are like Amazon or Mattress Firm or FedEx or companies like that. But those top 10 customers only account for 7.1%. The top is Amazon at 1.6%. Everything else is under 1%. So it is an extremely diversified business model. If the company goes bankrupt, no big deal. They can still continue to generate solid earnings. So I like that operator, the tenant diversification. Also like the geographic diversification. I mentioned the Sun Belt. They're right there in the middle of Mississippi, but really these smiley states, as I call them, really extend all the way from North Carolina down to South Carolina, Georgia, Florida, over to Texas, and then out.
Are their properties only in Mississippi, or do they own throughout the Sun Belt?
No, they have none in Mississippi. Like I said, they primarily locate in I call them the smiley states, right? So you think about the smile, you go North Carolina, South Carolina, all the way down to Texas, and then back over to Arizona and Colorado, Nevada. So it's all of these kind of southern, all the way from East Coast to West Coast markets. That's really where they operate. And these are all really, really good growth markets, which is really key. So they've got geographic diversification. They've got operator or tenant diversification. They're also fairly large in terms of their market cap. They're about $9 billion. That makes them the 3rd largest industrial REIT. Prologis is the largest. Then you have a cold storage company called Lineage, which just recently listed. And then you have EastGroup. So about the 3rd largest industrial REIT. Now, in terms of the balance sheet, this is what really excites me. Because again, to generate these very predictable earnings and dividends, of course, you've got to have diversification, which I just talked about, but you've also got to have a very strong balance sheet. EastGroup has one of the best, if not the best, balance sheets in the REIT sector. The company has only 13.7% of debt to total market cap. So that's one of the lowest debt ratios we see in the industrial sectors, and as well as the REIT sector as a whole. Then the debt to EBITDA ratio is about 3.2 times, which is extremely low. So again, they've got a very strong balance sheet, very disciplined management team, and they've been able to execute. As you can see from this fast graph, they've got a long history of earnings growth. That's when you see those dark shaded green areas in this fast graph. That shows the earnings, or the adjusted funds from operations, we say in REIT space, going upwards every year. In fact, every single year, and I've checked these boxes, you can see every single year since the company goes back to the recession, they've increased their earnings as well as their dividends. So they've got really appealing earnings growth. Their fundamentals are strong, great management team, good assets. In terms of valuation, I always like to close with this because this is the most important part and why we provide these YouTube shows, so we can show you the valuation. So the company's trading right now, and I put this on the chart here, you can see it about 26 times, and the normal valuation is closer to 29 times. So you've got this margin of safety that exists between what the current valuation is and kind of the historic valuation. When you look at the sum of the parts of how we project this company going forward, or forecast the company going forward, the company has about a 3.3% dividend yield. Again, it's not 4 or 5, but they have grown it every single year with a healthy payout ratio of around 80%. So I'm not fearful of a dividend cut given the quality of the balance sheet and the diversification that I mentioned. So you've got a couple things. You've got growth consensus. So we've got analyst growth estimates of about 8% going forward. You can see that on the graph as well. So when you combine the 3% dividend, 3.3% dividend, with roughly 8% going forward, consensus estimates in 26 are 8%, as well as 8% in 2027. And then you combine that with the multiple expansion, the ability for the share price to return to its close to normal valuation. We think this is a setup for about a 20% annualized returns, a really safe company, really strong balance sheet. Next, I'm going to go to Realty Income. I talk about Realty Income a lot, but again, I should, because this company remains one of the most cheapest sleep well at night companies that we cover. Again, they've got a very, very similar to EastGroup. They've got a very diversified portfolio of about 15,600 properties and over 342 million square feet. That's spread across almost 1,600 different customers or clients in 91 different industries. So they've been able to spread that risk across a number of different customers and uses. What's really interesting about Realty Income is that 91% of the rent is resilient to economic downturns and isolated e-commerce impacts. And that's extremely important. So when you look at this list, you see companies like 7-Eleven and Dollar General and Wynn Resorts and Lifetime Fitness, BJ's Wholesale. Those are very resilient customers. In addition, Realty Income has strategically expanded into Europe, where they own properties in the United Kingdom as well as Europe. And that provides them with diversification, but also the ability to generate lower cost of capital because they can obtain some of their debt financing in Europe as well. And so, in speaking of cost of capital, again, this is what I call, and I don't use this term lightly, when I call a company a fortress, when I say they've got a fortress balance sheet, I mean they have a very strong balance sheet. This company is A-rated, A3 and A- ratings by S&P and Fitch. They also have one of the best credit ratios, leverage ratios in the industry. They've got around 38% leverage and about 5.6 times debt to EBITDA. So again, very low cost capital, diversification. Finally, let's hit valuation up. Shares are still trading cheap. 13.7 times is the current valuation based on a historic valuation of about 18. And by the way, dividend yield is about 5.6% today. So the sum of those parts, and by the way, I'll put on the fast graphs, you can see every year, the company, much like one of yours, Nick, that you talked about, every year over the last 30 years, except for 1 year, Realty Income has increased its earnings. And of course, they've increased dividends every single year over the last 30 years, making them a dividend aristocrat on the way to become dividend kings. Okay, and that leads me to my third pick, Equity Lifestyle. Ticker symbol is ELS. Now, Sam Zell, who passed away a couple of years ago, was one of the founders of Equity Lifestyle. Equity Lifestyle invests in manufactured housing, RV parks, as well as marinas. So pretty large company. They've got a market cap or enterprise value of around $17 billion. That portfolio is spread across 455 properties, 173,000 sites. So very, very diversified business model in 35 states, as well as they got some exposure in Canada. When you look at the performance of Equity Lifestyle and really going back over, say, the last 10 years, the company has generated total returns around 211%, which has just scorched the competition. And to do that, what they've done is delivered annualized total returns since IPO of 14%. So that's a very, very attractive number. Now, I'm going to show you here as well on the fast graph chart. You can see that Equity Lifestyle also has a very solid history, and they've been able to increase earnings, again, every year going all the way back to the Great Recession. But you can also see on the chart that they're trading at a discount. Right now, currently, they're trading at 24 times their price to adjusted funds from operation compared to their normal valuation, which is closer to 27 times. Again, that dividend yield is 3.3%, just about what I talked about with EastGroup. However, growth estimates based on consensus is about 5% in 26 and 7% in 27. So once again, when you combine the 3.3% yield, with the growth that's forecasted of around 5, 6, 7%, as well as the discounted valuation, which we believe should increase over the next 12 months, especially if we have a rate cut, which is obviously a catalyst we're looking for in the REIT space. We think this company could potentially return 20% annualized over 12 months. So those are kind of three of my very high conviction, I guess, sleep well at night picks. Again, they're not the highest yielding players, but Nick, I think we're going to talk about some really high yield next week.
Yeah, I think that's the plan. And just to be clear, Brad mentioned the Silver Tsunami and then Equity Lifestyle. What they do is they have these manufactured home neighborhoods, developments, et cetera. And a lot of them have age limits. You have to be 55 years old to live there. So they create these sort of retirement utopias. They got pickleball courts, swimming pools, et cetera. They're usually on a body of water or on the coast. And that's why we like that as a Silver Tsunami play. It's not just manufactured homes for anybody. You actually usually have to be older generation. And that's where a lot of these people from northern states they're coming down south and retiring in these ELS communities. And like Brad said, yeah, next week we're going to talk about high yield. So this is a retirement. We're kind of looking for Swan, sleep well at night, very reliable income. You don't have to worry about a cut. The higher you go on the yield spectrum, dividend cuts become more and more likely. That's just how things work. Generally speaking, if a stock has a high yield, it means the market's not willing to pay a very high premium for that cash flow. And that's usually because the growth prospects are low. There's an inverse relationship between valuation and growth, generally speaking. We do like to find examples of irrational prices where that's not the case, but that's how it works usually. So, but Brad and I are going to do our best over the next week to find our favorite, very high yield, 7, 8, 9, maybe even 10% yields that we think are relatively safe and that, maybe could deserve a spot in a well-diversified retirement portfolio.
Yeah. And I like to refer to this kind of the portfolio blend is kind of the anchor and buoy. A lot of investors, including myself, like to build portfolios with these high quality sleep well at night stocks, but those are the anchors. But you also look for those buoys, those yield enhancers that allow you to increase your overall yield of the portfolio, recognizing that yield is important, income is important, especially for retirees who are trying to meet their fixed living costs and have a little bit of money left over for the grandkids or to play golf or whatever. So I'm definitely looking forward to that next week. Again, please drop us any comments below, hit us with a like, and we look forward to seeing you next week. And thank you for watching the show today. Nick, thank you for being the host here.
Yeah, happy to be here, and thanks guys for watching. We crossed 3,000 subscribers, so we'll mention that. Thank you guys so much. Yeah, that's a milestone we were waiting on. So now on to 5,000. Please like and subscribe, and we'll see you guys next Thursday.
Thanks for watching this episode of the Wide Moat Show. Please like and subscribe below. And also, please join us at the Wide Moat Daily for our dose of daily news. You can visit us at widemoatdaily.com. Thanks for watching us. Have a great day.